It's January 30th, 2026, and today we're taking a look at HP Inc., ticker HPQ. And if you just look at the numbers on a screen, it looks like an absolute steal.
Oh, absolutely. You see a PE ratio of what, 6 to 8? A huge dividend yield. It's basically everything a value screener is supposed to find.
But that's exactly how you get caught in a value trap, isn't it?
It is. Our research for this deep dive, I mean, we went through everything, the financials, the legal filings, and the picture is not a bargain. It's a huge warning sign.
The core idea we kept returning to in our analysis was this metaphor. We started calling HP the melting ice cube.
Right. It's the perfect way to visualize what we discovered. Imagine HP as two big buckets. The first one, the printing division, that's your ice cube. It's been the profit engine for decades, but it is actively melting.
And the second bucket, the PC business, is supposed to catch all that water.
But our data shows that bucket has a massive hole in it.
Okay, so let's start with the ice cube itself. Printing. The whole model was always razor and blade, right?
Sell the printer cheap. Make a killing on the ink.
But looking at the fiscal 2025 numbers we pulled, that whole loop seems to be broken.
It's not just seems to be. It is broken. And we found the canary in the coal mine. Hardware unit sales plummeted 12% last year.
12%. That's a collapse.
It's a huge contraction. If you're not selling the razors, you have no one to sell blades to tomorrow. The whole ecosystem shrinks.
Which is where their strategy gets, well, what we started calling the hostile moat.
Hostile is the right word, because they can't convince people to buy their ink anymore. They're trying to force them.
You're talking about the firmware updates.
Exactly. These dynamic security updates. We went through the class action lawsuits filed in late 2025. The plaintiffs are literally calling it malware.
Because it alters your property, your printer, to block cheaper third-party ink.
It serves the company, not you. And on top of that, they jacked up the prices on their instant ink subscription service.
By up to 50% in some cases. It feels less like a business strategy and more like a shakedown.
It is, and customers are running for the exits. We're seeing a clear trend of them defecting to Epson, to Canon, especially to those tank printers.
The ones that don't even use cartridges.
Right. You can't sue your way to customer loyalty. The ice cube is melting faster and faster.
Okay, so printing is a fortress under siege. Let's look at the bucket that's supposed to save them. The PC business.
The AI PC supercycle.
That's what management keeps talking about. A new wave of high-margin growth. But our research just doesn't see it.
It's a mirage. We called this part of our report profitless prosperity. The operating margins are razor thin. We're talking 5.8%.
Which means they have zero pricing power.
None. And this is the key insight from our technical analysis. HP doesn't own the AI. The AI comes from an Intel chip or Microsoft Copilot.
And so does Dell's. And Lenovo's. And everyone else's.
Exactly. The innovation is commoditized the second it's released. It just becomes a race to the bottom on price. There's no moat there at all.
So the fundamentals are shaky on both sides of the business. For our final sanity check, we looked at what the insiders were doing.
The skin in the game test. And this was maybe the most telling signal in our entire report.
While the CEO, Enrique Lores, is out there talking about a future-ready company.
He and the other top executives were dumping stock in late 2025.
And let's be clear, they were selling into weakness, at valuation lows. This wasn't taking profits at an all-time high.
No, this was bailing out, and we found zero insider buying to offset it. Zero.
Wow.
And if that isn't enough validation, just look at Warren Buffett. Berkshire Hathaway didn't just trim their stake. They sold every single share between 2023 and early 2025.
When the world's most famous value investor says there's no value left, you should probably listen.
You really should.
So to sum it up, for anyone holding HP because that PE ratio looks so cheap,
Yeah.
what's our final takeaway?
Our takeaway is that HP is a classic cigar butt investment. It's cheap for a reason. You might get one last puff of a dividend out of it, but the thing is soggy and the fire's going out.
That low PE doesn't matter when the earnings is in a state of structural decline.
Precisely. The denominator is shrinking.
So we'll leave you with this final thought. If a company's main strategy for survival involves declaring war on its own customers, is that a business you really want to own a piece of?
Invest wisely.